Higher interest rates may be bad for financing a home, but there is a silver lining. The most challenging part of investing and retirement planning has always been balancing asset growth with asset protection. To protect assets, we typically need to lower market risk, and to achieve growth, we need to increase risk. Now, with higher interest rates, we can actually do both. There are solutions positioned in ways we haven't seen before. Joining me to talk about this is my guest, Tim Tremblay with Tremblay Financial Services in Santa Barbara, California. Tim, let's start out with these strategies. How do these things work?
Well, you know, it's interesting. I had a client come in and talk to me about this investment that's in the market, but there's no risk on the downside. And I said, you know, that doesn't sound right. You better bring that in so I can take a look at it. So he brought in a fixed indexed annuity with Life USA. And as I looked at it, I thought, this is a great idea. They're using call options to get market-driven returns with no risk on the downside. And that was almost 26 years ago. And since that day, we've been using fixed indexed annuities as the foundation for our asset allocation for our clients at Tremblay Financial. And it's real simple how it works. It's with a call option. There are two types of options, puts and calls. The option market is a huge market. You have options on stocks, on futures, on indices. And what the financial services companies, the insurance companies are doing, they're just looking at a call option on the market. And so with this investment, it can only go sideways or up, never down. And what I like to do when I show my clients how this works is look at the worst 10-year period that we've seen in the market since the Great Depression. We call it the lost decade. And that would be 2000 to 2010. If you got into the S&P 500 blue chip stocks at the beginning of that decade in 2000, we were at a record high. The dot-coms had just brought us up there. And then over the next 3 years, we saw the meltdown of the dot-coms, we saw 9/11, Afghanistan, Iraq. If you had $100,000 in blue chip stocks at that time, 3 years later you'd have 51,000. And then over the next 4 years, we saw the market go up very nicely, fueled by collateralized mortgage obligations, which had a risk that we really weren't aware of at that time. And we saw the market go back to a record high, just a little higher than where we were in 2000. And of course, the Great Recession took place at that time. We saw if you had $100,000 in blue chip stocks in 2008, a year later, you lost 60% of your portfolio. Small caps, NASDAQ, other indices and positions were even more dramatic. And then it came back. But at the end of that 10-year period, from 2000 to 2010, in blue chip stocks, you would have been down 20%. Now, with fixed indexed, we're very grateful to have that as a foundation for our clients. Those first 3 years, as we saw a 50% decline, you didn't lose a dime. And then you don't have to make up losses with a fixed index. And as the market moved up over the next 4 years, our call options took us to a 40% profit, 2008. And then, of course, when the Great Recession hit, you saw the markets decline dramatically. We stayed at that 40% profit through the rest of that decade. So as you look at all the other asset classes, during the worst 10 years that we've seen since the Great Depression, the fixed indexed annuity was the best performing asset that we had, and we can use the word safe with it. And you know, Scott, I think that's what I like to show folks. If you show folks how the markets have done when things are going great, just about anything is going to look good. But how does your investment look when you're going through one of the most difficult times that we've had since the Great Depression?
So is this a good time to consider maybe refinancing an existing annuity?
You know, it absolutely is, Scott. When we look at where these fixed index annuities have gone over the past 25 years, there's been dramatic changes. Those early Life USA policies, in order to get the profits that you had with those investments, you had to annuitize over 10 years. That's no longer the case. The liquidity was 5% per a 5-year period, and you had to hold it for 10. So you didn't have the liquidity. Today, we have 5-year, 7-year, 10-year fixed index annuities, and you don't have to annuitize. They're contracts. They're much better. We have a whole wide range of indices that we can choose from. Your participation with higher interest rates will be better today than what we've seen in the past. So to answer your question, today is the best time that we've seen in the past 25 years to be looking at fixed indexed annuities. And if you're out of surrender with an old annuity, it might be a variable annuity. And you've heard a lot of bad press on variable annuities. They have management fees from the insurance company. The underlying mutual funds have management fees. You have risk of principal with the variable annuities. So that isn't for all people, and you have to understand there's a risk. The fixed annuities, based on interest rates, we haven't seen a decent interest rate in 15 years. And we've just seen short-term rates come up. Long-term rates, we have this inverted yield curve, are still not looking good for us. So the fixed indexed annuity continues to be, in our opinion, one of the best or the best place for your safe money in your asset allocation. And it's important to look at what you have now in the annuity arena and seeing if we can improve that and put you in a much better position.
And for someone considering the purchase of a fixed indexed annuity, what questions should they be asking?
Well, it's important that you understand that it's a long-term investment. Most of them are longer term. The shorter term ones won't give us quite the return that you will see with the longer term fixed indexed. You have to understand the liquidity that you have with those fixed indexed annuities. And then it's important to look at how can you get your return? What kind of index is going to be available to you as an investor? And the company that you're working with is so important. It's not just the return, but the service that you receive from these insurance companies is so important. So there's a number of different aspects that are very important for investors to look at as they begin their journey with a fixed indexed or continue it in a better way. And it's something we take a lot of pride in at Tremblay Financial. We're going to help our clients not only have the asset allocation to get them where they want to be in retirement, but when you look at each of the individual investments that we're choosing for that asset allocation, we're going to find the very best one for you.
That's Tim Tremblay in Santa Barbara, California. Thanks for watching Retirement News Online.